Hey everyone, welcome back to Bankers Bootcamp. Today we are diving deep into one of the most exciting areas of investment banking, mergers and acquisitions, or M&A. Over the next 20 minutes, we are going to cover everything you need to know about M&A, from the fundamental theory to two massive Indian deals that transform the whole FMCG and consumer goods sector. We will break down the HUL-GSK consumer healthcare merger and Tata Consumers acquisition of Capital Foods, examining exactly why these deals made strategic sense and what investment banks were involved. But before we jump into the deals, we need to understand the theory, the key concepts, and the modeling fundamentals that every investment banker uses when evaluating these transactions. So grab your notebooks because this is going to be packed with insights that will help you to understand how the biggest deals in India are structured and executed. Let's get started. What is a merger? What is an acquisition? Let's start with the basics. While people often use these terms, merger and acquisitions interchangeably, they are actually different. An acquisition is when one company purchases another company outright. The acquiring company obtains the majority stake in the acquired firm, which may or may not change its name or organizational structure. Think of it as a complete takeover where one company becomes the clear buyer and the other becomes the seller. A merger, on the other hand, is where two companies combine to create a new legal entity or when they integrate under one corporate name. In a true merger, the boards of directors of both the companies approve the combination and seek shareholders' approval. This is designed to benefit both brands, allowing each to bring their existing strengths to the new combined company. The key difference: in an acquisition, there's a clear buyer and a seller. In a merger, it's more of a partnership where both companies agree to move forward together as equals. Now, M&A transactions can be structured in several different ways, depending on the strategic rationale. Let me break down the main types. Horizontal merger or acquisition. This is when two companies operating in the same industry and at same level of the value chain combine. For example, when Marriott International acquired Starwood Hotels, that was a horizontal merger because both operated in the hospitality sector. Vertical merger or acquisition. This occurs when a company acquires another company at a different stage of the production or distribution chain. Apple's acquisition of Authentic, which makes fingerprint sensor technology for iPhones, is a perfect example of vertical integration. Conglomerate merger. This is when two companies in completely unrelated industries merge. The goal here is diversification rather than synergy in the same sector. Market extension merger. Two companies selling similar products in different markets combine to access a larger market base. Product extension merger. Two companies selling different but related products in the same market merge to expand their product portfolio. Congeneric merger. Companies in the same industry but with different products or services merge to leverage complementary capabilities. Why is M&A important? M&A is absolutely critical to the financial world and economic progress for several reasons. First, M&A drives capital formation and enables business to expand rapidly. Instead of building capabilities from scratch, which could take years, companies can acquire those capabilities overnight through strategic acquisitions. Second, M&A creates economies of scale. When two companies merge, they can reduce duplicate costs, improve operational efficiency, and increase negotiating power with suppliers. Third, M&A facilitates innovation and competitiveness. Companies acquire startups or competitors to access new technologies, talented teams, and intellectual property that give them a competitive edge. Fourth, from an investment banking perspective, M&A generates significant advisory fee and drives economic activity. Investment banks earn fees for advising on valuations, structuring deals, and facilitating transactions. We'll talk more about this later. Finally, M&A has global implications. It brings foreign investment into countries like India, creates jobs, and strengthens entire sectors. Major M&A activity often signals confidence in an economy and can drive stock market performance. Before you even open Excel to build an M&A model, there are several critical concepts you need to understand. Let's break these down one by one. Cash deal percentage. In any M&A transaction, the buyer has to decide how to pay for the acquisition. There are typically three ways: cash, stock, or a combination of both. The cash deal percentage refers to what portion of the purchase price is paid in cash versus stock. This is crucial because it impacts the buyer's balance sheet, cash flow, and debt levels. If a company uses cash, they are depleting their cash reserves or taking on debt. If they use stock, they are diluting existing stakeholders but preserving cash. For example, in the HUL-GSK deal, it was an all-equity merger, meaning 0% cash. Shareholders of GSK Consumers Healthcare received only HUL shares. Scenario percentage delta. When an investment bankers build M&A model, they don't just create one scenario. They create multiple scenarios to account for uncertainty. The scenario percentage delta represents the range of outcomes based on different assumptions. You might model a base case, a best case, and a worst case. The delta between these scenarios helps stakeholders understand the range of potential outcomes and the sensitivity of the deal to various assumptions. Investment banking fees. Investment banks don't work for free. They charge significant fees for their advisory services in M&A transactions. These fees can be structured in several ways: retainer fees, upfront fees paid at the start of the engagement, success fees, fees contingent on deal completion, usually calculated as a percentage of transactional value, fairness opinion fees, fees for providing a fairness opinion on the valuation, advisory fee, ongoing fees for strategic advice throughout the process. For large deals worth thousands of crores, investment banks can earn fees ranging from 0.5% to 2% of the transactional value. In the Tata Consumer Capital Foods deal, valued at 5,100 crore rupees, Kotak Investment Banking served as the exclusive financial advisor and would have earned substantial fees. Synergy created for the acquirer. Synergies are the additional value created when two companies combine that wouldn't exist if they operated separately. There are two main types. Cost synergy. These come from eliminating duplicate functions, consolidating operations, reducing headcount, and improving procurement efficiency. For instance, analysts expected the HUL-GSK merger to generate substantial cost synergies through media efficiency, lower staff costs, distribution advantages, and lower corporate overheads, potentially driving margin expansion up to 1,000 basis points. Revenue synergies. These come from cross-selling products, accessing newer markets, or leveraging combined brand strength. In the Tata Consumer Capital Foods deal, the significant synergy benefits were expected in the distribution, logistics, exports, and overheads. Synergies need to be quantified, and their value is typically calculated by projecting after-tax cash flows, assigning them a terminal value, and discounting at an appropriate rate. EPS accretion or dilution. This is one of the most important metrics in any M&A analysis. EPS accretion or dilution measures whether the combined company's earnings per share will be higher or lower than the acquirer's standalone EPS after the deal. If the combined EPS is higher than the acquirer's pre-deal EPS, the deal is accretive. This is generally viewed positively by investors because it means shareholders are immediately better off. If the combined EPS is lower, the deal is dilutive. This can happen when you pay a high premium, use stock as currency, or when integration costs are significant in the early years. The formula involves combining the pre-tax incomes of both companies, adjusting for acquisition effects like synergies, foregone interest on cash, and interest paid on new debt, then dividing by the new share count. Terminal value of synergy. Synergies don't just exist for 1 year, they continue to create value over time. The terminal value of synergy captures the perpetual value of these cost savings or revenue enhancement beyond the explicit forecast period. You calculate this using either a perpetuity growth method or an exit multiple method, then discount it back to present value. This can represent a significant portion of the total synergy value and justifies a higher purchase price. There are several other critical elements to understand. Purchase price allocation, PPA. How the purchase price is allocated across tangible assets, intangible assets, and goodwill. In the HUL-GSK deal, the hefty purchase price led to massive goodwill and intangible assets on HUL's balance sheet. Control premium, the amount paid above market value to acquire control of a company. In the HUL-GSK merger, there was a 15.4% premium to the undistributed share price. Closing conditions and regulatory approvals. M&A deals require approvals from shareholders, competition commissions, and other regulatory bodies. These can take 6 to 9 months or longer. Now let's dive into our first major deal of the merger of GlaxoSmithKline Consumer Healthcare India with Hindustan Unilever, or GSK-HUL deal. This deal was announced in December 2018 and completed in April 2020. It was one of the largest deals in the FMCG sector in recent times. Here are the key deal terms. Deal structure, all equity merger. Transactional value, Rs 31,700 crores. Exchange ratio, 4.39 HUL shares for every 1 GSK consumer healthcare share. Premium, 15.4% premium to undisturbed share price. Additional transaction, HUL also acquired the Horlicks brand for India for £375 million or 3,045 crore rupees. Investment banks involved. On the deal execution side, JP Morgan, Morgan Stanley, and HSBC served as book runners for the subsequent stake sale. These global investment banking giants facilitated the transaction and advised on the structuring. Strategic rationale, why it worked. For HUL, first, this acquisition was completely on strategy for HUL. Health and wellness was identified as a mega trend in India, and this merger positioned HUL squarely in that high growth category. Second, HUL gained access to iconic brands with strong market positions. Horlicks was the dominant player in healthcare drinks category, while Boost, Maltova, and Viva added to their portfolio. Third, the deal was transactional value accretive for HUL shareholders. Analysts projected significant revenue and cost synergies with margin expansion potential of up to 1,000 basis points. Fourth, HUL's distribution muscle could unlock significant growth. GSK Consumer Healthcare's brands would benefit from HUL's unparalleled distribution network across India. For GSK needed to fund a $13 billion buyout of Novartis stake in their consumer healthcare joint venture. Divesting the Indian nutrition business was part of this strategy. GSK received a good valuation. The deal valued GSK Consumer Healthcare at Rs 31,700 crore, representing a healthy premium. GSK retained a 5.7% stake in HUL post-merger, giving them continued exposure to India's growth. When they eventually sold the stake in 2020, they received gross proceeds of $3.4 billion, even higher than originally expected due to HUL's share price appreciation. Was it a good deal? From all indications, this was a win-win transaction. For HUL, the merger created a stronger portfolio in health and wellness, delivered significant synergies, and was accretive to shareholders. The only dilution was in promoter holding, which fell from 67.2% to 61.9% for Unilever. For GSK, they monetized an asset at a strong valuation, achieving their strategic objective of funding the Novartis buyout, and ultimately made substantial returns when they exited their HUL stake. What would they have lost if the deal didn't happen? If this deal didn't happen, then HUL would have missed a once-in-a-generational opportunity to enter to healthcare drinks category at scale. Building a competing brand to Horlicks from scratch would have taken years and massive investment with no guarantee of success. GSK would have struggled to monetize their Indian business at such an attractive valuation. The market for this asset was competitive, but HUL's strong strategic fit made them the ideal buyer. Both companies would have foregone these substantial synergies that only a combined entity could have realized. Let's move to our second deal, Tata Consumer Products acquisition of Capital Foods, which owns the popular Ching's Secret and Smith & Jones brands. Deal overview. This deal was announced in January 2024. Here are the key terms. Deal structure. All cash deal in a phased manner. Transactional value, Rs 5,100 crore on a no cash, no debt basis. Transactional structure, 75% stake acquired upfront before March 31st, 2024 with remaining 25% within 3 years. Additional deal, Tata Consumer also acquired Organic India for Rs 1900 crore in a simultaneous transaction. Investment banks and advisors. Kotak Investment Banking served as Tata Consumer's exclusive financial advisor on this transaction, with Khaitan and Company as legal advisors. Kotak would have provided valuation analysis, deal structuring advice, negotiation support, and helped secure financing for this substantial acquisition. Strategic rationale. Why it worked? For Tata Consumer. First, this acquisition allowed Tata Consumer to expand its product portfolio and strengthen its pantry platform. They were moving beyond tea, coffee, and salt into the fast-growing international cuisine segment. Second, there were significant synergy benefits in distribution, logistics, exports, and overheads. Tata Consumer's established sales and distribution platform could drive a volume growth for Ching's Secret and Smith & Jones. Third, the market opportunity was massive. The overall size of the categories in which Capital Foods operates was estimated at 21,400 crore rupees. Structural growth drivers included rising income levels, evolving consumer preferences towards global cuisines, and increasing needs for convenience. Fourth, the deal was margin accretive to Tata Consumer's business. The CEO, Sunil D'Souza, specifically noted this in the announcement, highlighting both strategic and financial fit. Fifth, Ching's Secret has a strong brand recall, especially among younger consumers who grew up with the brand. This gave Tata Consumers immediate credibility in the Indo-Chinese food segment. For Capital Foods, the founders and investors, including General Atlantic and Artel Asia, received an attractive exit at 5,100 crore rupees valuation. This represented a strong return on their investments. Capital Foods gained access to Tata's operational excellence and distribution reach, which would have been expensive to build independently. The Tata brand association added credibility and trust, particularly important in the food category. Was it a good deal? This appears to be an excellent strategic acquisition for Tata Consumer. The deal addresses a wide space in Tata Consumer's portfolio international cuisines, which is growing faster than traditional categories. The integration of Capital Foods' strong supply chain with Tata's distribution muscle creates a powerful combination. The phased acquisition structure also reduces risk, allowing Tata Consumer to validate the business performance before fully committing to the remaining 25% stake. For Capital Foods investors, achieving a 5,100 rupees crore valuation represents a successful exit from a company that had grown significantly under their ownership. What would they have lost if the deal didn't happen? Without this deal, Tata Consumer would have continued to rely primarily on traditional beverage categories, missing the opportunity to capitalize on changing consumer preferences toward international cuisines. Building a competing brand to Ching's Secret organically would have been expensive and time consuming, with no guarantee of matching Ching's Secret's existing brand equity and market penetration. Capital Foods investors would have to wait longer for an exit or accept a potentially lower valuation from a less strategic buyer. The opportunity to realize synergies worth hundreds of crores across distribution, logistics, and overheads would have been lost. M&A has been absolutely transformative for the investment banking industry. Historically, investment banking emerged to help companies raise capital and facilitate transactions that would have otherwise been impossible. The M&A advisory business became a cornerstone revenue stream for investment banks, generating significant fees and establishing long-term client relationships. In India, specifically, since the liberalization of the early 1990s, investment banking has played a pivotal role in economic development. M&A transactions have facilitated capital formation, supported infrastructure development, and fostered innovation. Major infrastructure projects like the Delhi-Mumbai Industrial Corridor have been financed with investment banking support. High-profile investments in technology and digital platforms have catalyzed new growth sectors. In today's world, M&A represents economic progress on multiple levels. At the company level, M&A enables businesses to achieve strategic objectives quickly, entering new markets, acquiring technology, eliminating competition, or achieving scale. At a sectoral level, M&A drives consolidation and efficiency. creating strong players who can compete globally. At the national level, M&A attracts foreign investment, creates jobs, drives innovation, and strengthens the financial system. When a company like Tata Consumer acquires Capital Foods, it signals confidence in India's consumer market and creates value across the entire ecosystem. Investment banks facilitate all of this, acting as advisors, intermediaries, and deal makers. Their expertise in valuation, structuring, negotiation, and execution makes complex transactions possible. The future of M&A is being fundamentally reshaped by artificial intelligence. By 2025, more than 80% of Tier 1 investment banks are using AI across front, middle, and back offices. AI is estimated to unlock $1.2 trillion value in the investment banking sector annually through increasing productivity, lower costs, and revenue growth. Specific applications in M&A. Due diligence automation. AI can analyze thousands of pages of documents within hours rather than weeks. Machine learning algorithms scan legal documents to identify red flags, regulatory compliance issues, and contractual obligations. This has cut diligence timelines significantly and reduced costs. Valuation and financial analysis. Advanced algorithms process years of financial data to identify trends, anomalies, and potential concerns that human analysts might overlook. AI can cross-reference multiple data sources simultaneously, creating comprehensive financial profiles. Deal origination. Companies using AI applications to sift through market data, earnings releases, and macroeconomic data are seeing up to 40% more deal flow. AI identifies potential targets that fit strategic criteria before competitors do. Synergy identification. Generative AI can analyze sales data, pricing models, and customer demographics from both companies to quickly identify cross-sell opportunities and revenue synergies. This allows acquirers to include higher revenue synergy projections with greater confidence. Risk assessment. AI platforms analyzing social media and news content can identify growing negative sentiment about a target's product quality or reputation. These early warning signals help acquirers adjust deal terms or walk away from problematic transactions. Looking ahead, AI will continue to evolve the M&A landscape. Investment banks that successfully implemented these technologies will maintain competitive advantages through faster deal execution, improved accuracy, and enhanced client service. However, AI won't replace investment bankers. It will augment them. By automating data-intensive processes, AI frees deal terms to focus on higher-level strategic analysis, relationship building, and creative deal structuring. The regulatory environment is also adapting, with regulators recognizing the benefits of AI-enhanced analysis while establishing guidelines for appropriate use. In the Indian context, as our market continues to mature and deal complexity increases, AI will become indispensable for evaluating the hundreds of data points that determine deal success. So, there you have it, a comprehensive look at mergers and acquisitions from theory to real-world deals to AI-powered future. We covered the fundamentals of M&A, broke down critical modeling concepts like EPS accretion and synergies, analyzed the HUL-GSK and Tata Consumer Capital Food deals, and explored how AI revolutionizing this whole space. In our next video, we will actually build out an M&A model using these exact deals, walking through every step in Excel. You will see exactly how to calculate purchase price allocation, synergies, pro forma financials, and accretion or dilution analysis. If you found this video valuable, please hit that like button, subscribe to Bankers Bootcamp, and drop a comment telling me which deal you found most interesting, HUL-GSK or Tata Consumer Capital Foods. I'll see you in the next video where we dive into the actual model. Until then, keep learning, keep growing, and I'll catch you soon.